Hello everyone and namaskar and welcome to the show on indirect taxes. We once again have Pranav Kapadia, partner of our firm and focusing completely on GST for so many years, more than 25 years now. And lot of stuff has been evolved over a period of time. You know that there was VAT, there was sales tax before VAT, then came the era of service tax, and then came the era of GST finally on 1st of July 2017. After that, lot of changes happened with the help of council discussions and council meetings over and over again, because this law is completely driven by notifications and circulars. The changes were incorporated overnight in various aspects of GST, wherever the government felt that there is a need to curb any leakages or any issues. One of the issues that is been covered lately and lot of hue and cry has been seen in the industry with regards to the corporate guarantees given by the parent companies to their subsidiary companies, which in turn use them to get loans from the banks or financial institutions and use these loans for the development of the companies. Here, the related party model of transaction triggers where there is zero fees charged by the parent company to the subsidiary company, or very nominal fees is being charged by the parent company to the subsidiary company, or a branch to another branch, or an HO to another HO, or a multinational company to another local company in India, which is the subsidiary of such multinational company. All these scenarios have become a big question mark. The government has brought in 1% valuation on all these different transactions, 1% of the corporate guarantee given as taxable value, and this further created confusion. We were creating a video, a blog on this topic beforehand, but we thought that further clarifications are awaited. So we actually waited for creating this blog. Now is the time when all the clarifications are on the table. There are case laws like Acme Clean Tax Solutions, which went till the High Court in Punjab. And there was another case law for Edelweiss Financial Services Limited and in the service tax era, which went up to Supreme Court. The government, through this circular, or the council through this circular, is trying to overturn certain situations and see it in a different way and try to cover these transactions through valuation rules in the GST Act. Okay, let's start questions one by one. Pranav bhai, welcome to the show. And thank you all the viewers for taking interest in these topics of immense importance. We are trying to simplify and keep very, very easy answers for the owners, directors, CEOs, CFOs of the company, whom we feel need technical guidance but have been little technical about GST. So it will be very, very easy and convenient for all of you to understand this stuff. Please be with us till the end of the videos, because there are a lot of scenarios and aspects which we are trying to cover in this video. Let's go one by one. So Pranav bhai, please briefly explain what has come in via this latest thing which has come in on 26th of October 2023 via Rule 28.2, which has been added in the GST law.
Yes. So, hello everyone. Thanks, Mitesh, for the kind introduction. 25 years, of course, it's not GST, it is indirect taxes that I've been dealing into. As you said, VAT, service tax. Earlier, it started with the VST period and then VAT, service tax, and now GST. But yes, a notification and circular driven law, and that is what is still happening under the GST regime. Indirect taxes work in this manner only. Government tries to levy tax on certain things which it feels is necessary for collection of revenue. Indirect taxes, as we all know, the revenue is collected on the gross value billed or to be billed, or rather, in another GST regime, even if it is not billed and if it is between related parties, then the valuation mechanism is prescribed Okay, in case of related parties, then even in case of services, there will be a certain type of valuation mechanism which should be valued even if the amount is not actually paid. Still, there will be a valuation mechanism through which the taxes will have to be paid. Something like the stock transfers that we had earlier under the excise and VAT regime, and now even under GST, even for goods transferred from one branch to another, there are valuation mechanisms on which tax is to be paid, even if it is going to its own pocket. So earlier also the government had been charging tax on it. There were certain concessions earlier. That F form was there for the goods transfer, stock transfer, etc. Well, now coming to GST, especially with regards to this corporate guarantees, which is the topic for the day, taxation of GST on corporate guarantees. Well, I think government is trying to levy tax on corporate guarantees. Now, what is a corporate guarantee? Say there is a company A and a company B. They both are related parties, and the company B is in need of funds. And say there is a bank C. The bank C wants to fund the amount or give the loan to the company B. But the company B is not having that potential of taking that loan, and the bank wants a guarantor. And where the company A, which say it is into business since many long years, has a good standing in the market, and that company gives the guarantee to the bank for giving the loan to company B, and that is called as a corporate guarantee. And so the transaction is between the contracting parties are company A and the bank C, and the beneficiary of this transaction is company B. So this is how the corporate guarantees function. I can also give one more addition to this, that there is also personal guarantee which is generally given either by the partners or the directors of a company for say another related party or for the same company, or it could be others also. So that is covered under personal guarantees. And this has been the bone of contention, that whether there should be a liability on such services provided by the person giving the guarantee, either the director or the company giving the guarantee to the bank for another related person, and that has been the bone of contention. We'll be discussing more on this aspect as Mitesh is, he has found out, and we have had a pre-discussion of almost an hour, just to identify that which are the aspects which can get covered under so many aspects are getting covered. Mitesh will take us through all those questions. Yeah, Mitesh.
Yes. So this is very interesting, and it has been observed that lot of such transactions which were looking like transactions of zero value, and which were looking like very obvious that the parent company will always give things to the subsidiary company. Be it corporate guarantee, be it brand image. Now this brand image is also come under question mark in the case of Mahindra, which is becoming a very hot discussion in the newspaper. If you would have seen that, using brand Mahindra means taking some services from the holding company of Mahindra. So things have evolved over a period of time, and lot of such transactions are being zoomed in by the department and seen in a different manner and observed as services given by one company to another company and wanting to charge tax on such situations. So the first question that comes in everyone's mind is whether such transaction means service at all or transfer of supply of service at all. If there is no supply of service, how can there be GST? That is the question. So, Pranav, the question is whether this means supply or not.
Yeah, so I think what I understand is basically in the same example, we continue with the same example for this entire session. Say company A is giving a guarantee to the bank C for taking a loan by bank B. That company A is doing for itself generally, because and generally these are holding and subsidiary companies. The generally, or it could be a branch of one company to another company. That in that case also sometimes we have seen in some cases that even for say a branch at Mumbai, the head office at Mumbai, branch is at Delhi, that branch could have become a part of this company through some merger acquisition which could have taken place, and there could be their existing bankers which were over there. This company has different bankers. Now the umbrella company is the main company which is handling these cases. So it could be such cases also. The question is that whether there is any service which is being given by the company A in such cases, who is given the guarantee. In my personal view, I think there is no such service which is being provided, because what it is doing it for itself, because it is a subsidiary or a branch of that company itself. And if they don't provide it, that company will not be able to give the desired results or not be able to perform in a particular manner. And again, the transaction which is happening between the company A and bank C. The beneficiaries of that transaction is company B in this case, but there is no direct service which is being provided by company A to company B. And what is being sought to be taxed as per the GST law is a service which is provided by the company A to company B. Of course, department may take a different view and is already taking a different view in such cases, and that is why there are so many amendments and changes in the rules, in the law, 3 or 4 circulars clarifying this aspect, trying to clarify this aspect, and they all have proceeded with one presumption, that such corporate guarantees are a supply under the GST law and they are liable to service tax. So either we challenge the genesis of the transaction, that it is not a supply, it is not a service, and hence not a liability. But it is going to be a very, very difficult uphill task for the taxpayer, seeing the way the department is functioning and trying to do that. If you want to challenge it, I think the challenge is there in cases where the bus has been missed, etc. But where in cases where maybe it's for a future transaction, it can be planned out properly, and then if it is required, the taxes can be paid, credits can be taken, etc. Wherever full credit is available, so that can be done. So the so as Mitesh mentioned, in the case of Edelweiss Financial Services, the matter went till Supreme Court, wherein a corporate guarantee was given to one of its sister concern. And there, the Supreme Court in that matter held that since no consideration was received by Edelweiss for providing that bank guarantee, hence service tax was not payable on that bank guarantee amount. The department had levied it, but there the issue was that there was no Schedule 1 as we now have under the CGST Act. We have a CGST Act which has a Schedule 1 and which deems certain supplies, even if they are without consideration, there is a valuation mechanism provided. Even if it is without consideration, it will be deemed to be a supply with consideration, and some mechanism, valuation mechanism is given. And that is what is the entire challenge. In last year itself, the Supreme Court had given this judgment, and thereafter in June 2023, the council recommended it in its council meeting. And then in October 2020, suddenly on 26th October 2023, we don't know what is the importance of that date, 26th October. I think it is just by way of processes that this date came when the circular came into being, and that when the notification came into being and Rule 28 got amended. So I think so the point is that even after the Supreme Court judgment telling that without consideration there is no tax, so possibly the government is now trying to levy tax on those corporate guarantees which are issued without consideration. The rule says the value, if there is a consideration, that consideration will be taxable. If there is no consideration, there is a valuation mechanism as per Rule 28. So based on that, whichever is the higher value will be deemed to be the value of supply on which GST will be payable. And that is what is sought to be done.
Okay. I think this is going to create huge hassle for a lot of multinational companies and parent companies, big groups like Tata Groups, Reliance Group. All these groups keep on giving lot of corporate guarantees to inter-subsidiary companies or companies which they want to grow fast at a faster track, and use their reputation with the bankers to make available facilities to their subsidiary companies or their sister concerns in different ways and means. So all these transactions will get challenged. But let's now, as of now, imagine or assume that everything will be considered as supply, and the model of the department would be upheld, because we as taxpayers or you as taxpayers, it is critical that you plan things in a conservative manner so that you are not stuck at the end of the tunnel and you don't get into a trouble later on. So let's assume that everything will be considered as a supply and there will be impact of this 26th October circular and notification at the wider scale. So let's look at cases both where there is ITC available to the subsidiary company for such cost that they incur for corporate guarantee, or you can say deemed value of the corporate guarantee, and the cases where the deemed value of corporate guarantee is not available as credit to this particular sister concern or the smaller entity or the subsidiary company. In both these cases, how the calculation will happen with regards to the valuation of such supply.
As Mitesh rightly mentioned, we'll have to look this from two aspects. So I think let me now take you to the little background of how this taxation of corporate guarantee works. The rule 28.1 was already there on statute. Rule 28.1 had a second proviso, which stated that. So what was Rule 28.1? Rule 28.1 stated that it gave the valuation mechanism of how goods or services need to be valued in certain cases. It generally mentioned that if you have similar kinds of goods, then the value of that, or if you know the cost of those goods plus 10%, or cost of those services plus 10%. So different valuation mechanisms were provided. It had a second proviso, which stated that in case the recipient is eligible for full input tax credit, then whatever value is declared by the recipient on the invoice, by the supplier on the invoice, that value will be deemed to be the value. So in cases where, say, a nominal value was, if the value the company could identify, it could be the value which is identified. If the value is identified and charged to the sister concern, that will be the value. In case if nothing is charged to the recipient, then, and if the recipient is eligible for full input tax credit, then whatever is the value which is deemed value, that value will be allowed by the department. The recipient will be considered as eligible for that he'll be able to take credit of that value which is charged on the invoice and the GST thereon, and the supplier whatever value is given, that will be allowed. This was also clarified through circular number 199 in case of cross charge, wherein they had told that whether what should be included in the value, what should not be included in the value, whether employee cost should be included or not included in the value, because employee cost is a big cost, right? So that was in relation to cross charge. But the sum and substance was that in case if the recipient was eligible for full input tax credit, then whatever value has been mentioned by the supplier in such cases will be accepted by the department. In that circular, they clarified one more point, that even if the supplier issues a nil value invoice, that nil value will be the declared nil value. Nil value declared will also be considered to be the value of that supply. So a very good circular was there. Now, when this rules came of Rule 28.2 came in on 26th October 2023, such proviso was missing in the Rule 28.2, and this led to more confusion. What will happen in cases where full input tax credit is not available to the recipient? So there the risk seemed to be much more higher in that cases. And then in July 2024, proviso was inserted in Rule 28.2, which was for that corporate guarantee. A proviso was inserted in that Rule 28.2, which was similar to the proviso in Rule 28.1, and therein they clarified that okay, even similar in similar cases, in Rule 28.2 also, if the recipient is eligible for full input tax credit, then whatever value has been mentioned in the invoice or declared in the invoice for the corporate guarantee, that will be deemed to be the value of the corporate guarantee. Only thing is that the main rule says that the charge will be whatever value is deemed value or actual consideration, whichever is high. So that needs to be taken care.
Great. So this gives a sigh of relief to lot of
Yes.
companies which are into parent subsidiary relationship and having corporate guarantees. We were imagining that lot of companies will get covered. There will be valuation hassles. Although credit is available, but the valuation can be questioned by the department. And later on, if the valuation goes up, there is a chance that the other party may lose the credit. So this may create a lot of hue and cry. But now, since this clarification has come in, I think lot of issues are resolved. 80-90% of people who were getting covered or perceived to be getting covered are out of the net, technically out of the net. So remaining people who don't claim credit or are ineligible for the credit or
Full,
are
full,
exempt
not
supplies.
eligible for full input tax credit.
Yes. So those will get triggered or covered into this category. And only to that extent, this 1% per year or per annum model of corporate guarantee valuation will be impacted, and they will have to do the invoicing, and accordingly the other party will be required to actually show it in the books but lose the credit to that extent. So technically, if it is a 5-year corporate guarantee, do we mean that this will be applicable 1% per annum means 5% over a period of 5 years, and every year one will have to pay tax at the rate of 18% on that 1% of value, right?
No, so here we need to understand that when the Rule 28.2 first came on 26th October 2023, at that point of time they had mentioned that the value of corporate guarantee will be 1% of the guarantee given or the actual consideration, whichever is higher. Then on 10th July 2024, they made a retrospective amendment to this rule with effect from 26th October 23 again, that this 1% has to be taken as 1% per annum and not just 1%. So now, as the example given by Mitesh, that if the guarantee is given for 5 years and the guarantee is given at one stroke of time, say in August 2024, the guarantee is given for 5 years, then what should be the charge? Whether it will be 1% per annum means if it is for 5 years, there's a circular number 225, which came very recently, or rather it came on the next day when the amendment came. The amendment came on 10th of July, the circular came on 11th of July, and it clarified that if that in such cases, if the guarantee say it is given in August 24, say a 1 crore guarantee is given in August 2024, and 1%, and it is given for 5 years, it has to be taken as 1% per annum for 5 years. So 5 years, and what is the time of supply? The time of supply happens when the guarantee is given, and if it is a continuous single guarantee for 5 years, then 5% will have to be paid by the person giving the guarantee. So it will be 5% in such case if the guarantee is for 5 years. It is 10 years, then 10%. One more clarification which has come in this: say if that guarantee is of 5 years, or rather if that guarantee is renewable every year, it may be other way around, that okay, we may cover a period of 5 years, but if its guarantee is for which is to be renewed every year, reviewed every year, and renewed every year, which is there in major of the cases, then it will be that 1% per annum will be on every renewal. So in case if there is no renewal in between, at a stretch 5 years, then 5%. If it is 3 years, 3%, etc. Or if it is every year renewal, then 1% per annum every year.
Okay, okay. So one has to be very, very careful while doing the valuation calculation, and have to do the valuation and the time of supplies when the first start of the guarantee happens, right? Or is it at the end of the guarantee, or is it flowing throughout the guarantee?
The time of supply is when the guarantee is given. So at the first day when the guarantee is given.
So entire, say, 5-year guarantee is given, then it means that 5% of the guarantee value, say 1 crore worth of guarantee is given, then 5% means 5 lakhs. And on that 5 lakhs, one has to pay 18% tax.
Correct.
That is how the calculation will happen. If there is a renewal every year, then every year the guarantee will be considered to be as fresh guarantee transaction, and accordingly, for 1 year only, the tax will be charged at 1% value, and 18% will be charged at the 1% value. So that is how this will happen. Am I correct?
Yeah, so yeah, so 1% per every time, each of the year, there is no 80%. The point is that it will be on every renewal 1%.
Okay.
1% at every renewal. Then okay, then there is one more point which is clarified in the circular, which says that okay, the guarantee may be given for 1 crore, but the loan taken is of only 80 lakhs. Okay, so then on what value? Whether on 1 crore it should be payable or on 80 lakh rupees. The circular clarifies that it is on the guarantee amount given and not on the loan amount disbursed or availed. So,
Okay.
okay, so it has to be on 1 crore rupees in such cases, on the
So
guarantee.
again, I would want to relook at this, that are we saying that 1% is the value of supply or deemed value of supply, or 1% is a tax on the
1% is the deemed value of supply.
okay, and
So,
tax is 18% on that deemed value, right?
yes.
Correct. That makes things very clear. Now let's get into one more question. Pranav, in the case of multinational companies which are located in, say, USA or UK or any other country for that matter, giving corporate guarantees to their bankers in USA, UK, or any other country, who are also the bankers of their subsidiaries in India, who are going to utilize these corporate guarantees as one of the beneficiaries or the beneficiaries in the group through the corporate guarantee which is being given abroad. How will these companies get impacted? Whether reverse charge mechanism will trigger in such scenarios, and what will be the process through which they will have to pay the tax or value these transactions?
Correct, correct. Yeah, so in case if a foreign company is providing a guarantee for an Indian subsidiary or a parent company, parent company or a foreign holding company is providing guarantee for an Indian company. Again, we are talking of a situation which is without consideration, or at every point of time, our every discussion is either the deemed value or the actual consideration, whichever is higher will be taxed. So every time that comparison will have to be made, that valuation will have to be made every time. Okay. So now, since in this example, now the company is situated outside India, then whether this rule will apply? According to me, yes, the rule will apply again in this case. Again, we have schedule 1, wherein in case if there is any import of services without consideration, then the recipient will be liable to pay tax under reverse charge mechanism. The earlier point that we discussed was when a Indian entity, company A, was giving bank guarantee for company B, both were in India, and then forward charge was applicable for company A. Now say there is a foreign company X which is giving corporate guarantee for the company B in India. Correct. Then in that case, the company B will be liable to pay tax under reverse charge mechanism. This has also been clarified through one more circular that liability will be payable. Again, one more thing, one good thing which has been clarified in that circular is that, again, in this case, like in the Indian entity, if this import of services, the company which is going to pay tax under reverse charge mechanism for the corporate guarantee given by foreign company to the Indian subsidiary under reverse charge mechanism, and say that Indian company is eligible for full input tax credit, again there will be no liability in such cases, or whatever is the deemed value which is taken will be accepted by the department. So again, it is a saving grace in such cases.
Correct, correct.
Yeah.
So the multinationals will also have to be careful, and the subsidiaries of multinational have to also be careful, reassess all the corporate guarantee transactions, and they take due care. I have seen multinationals giving umbrella corporate guarantees to the bankers. Say 100 crore corporate guarantee is given. Now multiple subsidiaries across the globe are using these 100 crores in a rational manner according to the resolution of the board of the parent company, and accordingly the things happen in the subsidiary companies. In such scenarios, maybe they will be able to use the pro rata basis for calculating the corporate guarantee, This is my hunch, but there is no clarification in
No,
my.
because your hunch is right, and in Circular 225, a similar pro rata or proportionate basis example is also given in Circular number 225. In that circular, say if there are two companies, company A and company B are giving a guarantee for company C, then both of them will have to pay 50-50.
Oh,
Say, yeah, so that example is also there.
okay,
In case if the ratio of the corporate guarantees say is decided between, if it is not decided 50-50, if it is decided that okay it has to be 60-40, then as per the terms of the agreement, see all this is always very much clear cut depicted and inked out in each and every document, because these are transactions of huge value. Everything is always in black and white, and each company knows what is its actual liability. The bank knows it, the person giving the guarantee knows it, the person taking the guarantee knows it. So if it is if the amount if there are two companies who are giving the guarantee and they are not specified, then 50-50. If they are specified, then whatever ratio they have specified, 80-20, 60-40, 70-30, whatever may be the ratio, that will be the ratio which will be taken on proportionate basis payable by each company, whether under forward charge or under reverse charge, as the case may be applicable.
perfect, perfect. So we have to be very, very careful. Mainly the multinational company subsidiaries or branches in India have to take proper care while doing the calculation. Proper consultation is required to be taken before disclosing these transactions or doing any invoicing or structuring around this transaction in a systematic manner. Only risk is higher in case of companies who are not eligible to claim full credit or are having exempt sales on the sales side, and on the purchase side they have some credits to be claimed which they have to lose. Technically they have more worries than the companies who have eligibility to take or claim full credits. So with this we go ahead to the last question. There are dates like 26th October 2023 where the notification got triggered, and there is now the new date which is 10th of July 24, where the clarification with regards to this circular has arrived. So there is a huge gap of around 8-9 months with regards to this clarification that has arrived. Also, there are transactions from 1st of July 2017 when GST started. So there is a huge gap between 26th October 23 and 1st July 2017. In such scenarios, there would be hundreds, thousands of corporate guarantee transactions which would have happened. They would have ended before 26th of October 23, no problem. They are still ongoing, and there are situations where they are still ongoing after 10th of July. So one will have to be very, very careful on whether this impact is retrospective, prospective, retrospective with regards to the previous date, retrospective with regards to the current date, how things will impact and what will be the impact, Pranav bhai.
Yeah. I think very interesting situation for all the taxpayers. So the first question is that the recent amendment. I think we'll start with that. Mitesh started with it. We'll start with that. The recent amendment which came on 10th of July 2024, making a retrospective amendment from 26th October 2023, telling that this 1% has to be read as 1% per annum. So this 10 July date, will lose its importance in the sense that everything becomes applicable under the new rule with effect from 26th October 2023 itself. So 1% per annum will become applicable from 26th October 2023 itself. So in case any guarantees are given after 26th October 23, say in December 2023, a guarantee is given for 5%. At that point of time, the company might have considered the new rule and paid for 1 year, or rather would have paid 1%. Now its liability becomes 5%, and that has come retrospectively. So yeah, and that would also lead to interest implications. It is either challenging the virus of this, that how can you bring a retrospective? How would I know? The taxpayer would know in July that in July 2024 such an amendment would come retrospective and would levy and would make a charge that my liability will increase. No, so somebody, if they want to challenge, I think this notification can, this circular can also be challenged because it is levying a charge at a certain rate and it cannot be brought through the rules. Although it has come through a notification, but can the rules bring such a charge on the person where he was not aware that in somewhere after a few months this will be a charge which will come. So I think this aspect can definitely be challenged, and I'm sure there will be companies who will be challenging this aspect. Now, so between 10 July and 26th October, 26th October is the date, but of course 10 July being retrospective, and if certain cases have occurred for 1% per annum, there's a scope for challenge, subject to if the company wants to litigate. If it is eligible for full input tax credit, there will be not much of a hassle or issue. Otherwise, there could be a hassle. Okay. Now, between 26th July 23 and retrospectively from 1st July 2017, whether this amendment is applicable retrospective? The answer is this amendment is not applicable retrospectively directly from 1st July 2017. But the aspect that corporate guarantee is a supply, this supply is taxed in a particular manner after 26th October 23, does not deviate from the point that pre 26th October 23, this transaction was not a supply. Okay, there's a particular valuation mechanism which is provided after 26 October 2023. Prior to 26 October 2023, also there was a valuation mechanism. Rule 28.1 was there on statute. So there, it is that there was a mechanism. But the mechanism per se was not a complete mechanism which will enable a person to value those services by that system. So if you try to, I'm just trying to open up that mechanism. One moment. So Rule 28, it stated that the value of supply of goods or services between distinct person as specified under so and so section, where the supplier and recipient are related, shall be the open market value of such supply. Now, does a corporate guarantee have an open market value? Can this aspect be challenged? Answer is yes, it can. There is no open market value because it is between myself and my entity, myself and my sister concern, me and my brother, me and my sister. There is no open market value. This is on 1:1 basis. So there is no open market value for valuing such. Then the second row, Rule 28.1b says, if the open market value is not available, be the value of supply of goods or services of like kind and quality. So it is telling that if say, I'm just giving names for just example, it should not be taken otherwise, just an example. Say if the Tata Group is giving guarantee in certain situations to certain of its entity, can it be equated to Reliance Group or Adani Group or any other such group that under which circumstances of like kind and quality those guarantees are being given? There could be so many differences, so many factors affecting such guarantees, and so many scenarios affecting such guarantees. So that rule again, although that rule is there for valuation, that rule I don't think it can help. Then it further says if it is not determinable under A and B, the value is determined under Rule 30 or 31. Now, what does Rule 30 say? You find out the cost of that and add 10% to that. Now, what is the cost of giving a corporate guarantee? How do I determine that? It is not a product. It's not goods that I can determine. That okay, this material will come at so and so much raw material. Okay, there could be changes. There could be quality differences in that raw material. I take this quality material and this quantity material, which will make a finished product in such and such manner, and then I add 10% of that cost and my admin cost. So many things. But can this be applied to a corporate guarantee? I really doubt whether that rule can be applied. And the Rule 31 is the residuary rule. What under special circumstances, what the company feels could be the best valuation level. I think there is no valuation mechanism at all. So, trying to apply the Rule 28.1 before 26th October 2023 is a big challenge by itself. And although there is a mechanism, there is no specific mechanism which is provided like Rule 28.2. At least it says 1%. Something, कुछ तो clarity दिया है उनमें 1% of value level. Otherwise, what value they may take? Okay, somebody says, okay, even bank gives guarantee, bank takes 2%, you charge 2%. But that is bank's prerogative. It is how the bank functions. They are those bank charges. This is my company. My sister concern is in need of funds. I need to give it to save my image. Okay, so there could be hundreds of different situations and aspects which can lead to it. So in case if somebody wants to really challenge, so first challenge is before 26th October, first challenge is you challenge this whether it is a supply or not. If it is not a supply, there is no tax. Okay. Second, whether this rule is retrospective, the rule is not retrospective, it is prospective. The valuation mechanism is provided prospective. Third, whether rule 28.1 will trigger, the answer is 28.1 triggers. Even the circular 225 says that rule that in case of previous where guarantees are given prior to 26th October, it should be valued as per rule 28.1. But when you go through this entire rule 28.1, there is no mechanism specifically available, and the mechanism rule fails. Now, this we have seen in the cases of the Builders Association, wherein under VAT there was a challenge till the Supreme Court, and there the Rule 58, which was there on statute, it had got amended just before the final hearing of the Supreme Court, that to provide for deduction of land, because whenever a builder sells his property to a customer, there is a value of land which is embedded. It is not only the construction, there are so many factors, and there was no valuation mechanism provided to those builders, and that is why the government had come out that the state government, at that point of time it was the state government should come out with rules for providing a land deduction or a lump sum 1%, as a composition scheme. So that is what the provision was amended. Rule 58 under the embed rules was amended. The matter went in Supreme Court, and the valuation mechanism, since it was not available, it failed. The government had to come out with a valuation mechanism in such cases, and that is how it got operated. The only challenge is now whether this Rule 26, which 28.2, can the government now tell that now this rule is applicable retrospective? I am doubtful. That is again going to be a big challenge again by itself. So as of now, lots of challenges in how to value in case of it not, tax would not have been paid by many, or most of the people have not paid taxes in such cases. And even the Edelweiss case was going on under service tax regime, which went till the Supreme Court. And based on that, many have not paid those taxes. It is still, a fight worth giving to the government, that there is no valuation mechanism provided for those periods. Even if it is, there is a rule, it fails. You can challenge the supply itself. So lots of points, for the taxpayer in such cases. It all depends on the risk appetite and the quantum involved. But yes, there are various challenges and which can be challenged.
Correct, correct. Only concern is all these complications are giving lot of headache and lot of confusion to the taxpayers all this while, and they are resulting into disruption in the business and the business transactions that are going on day-to-day basis. Today, people are thinking whether they should do it or not. If yes, how to do it, what value, what structure, and so on. So, lot of confusion has gone up in this regards. So let's wind this up, and let's give a disclaimer that these are just our thoughts, our personal thoughts. They can't be claimed as our firm's final thoughts. And also, we have to be very careful while taking any decisions as owners of various corporations or companies, directors, CFOs, and consult the valid and good consultants before you take any conclusion on these aspects. These are more clarificatory and educational in nature, and they continue to be educational in nature. Your transaction, your structure, your issues, your situation, your cash flows, all these things, all these aspects need to be taken into consideration before taking any final call in such conditions and such situations. So better be consulted before taking final call on this aspect.
It's very fact specific, so it depends on the facts of that case. So I think it's better to take a.
With this, we would like to close the conversation. Pranav bhai, thank you for being on this show. And we continue to do a lot of amendments and changes which come on over a period of time and try to clarify and help the taxpayers in indirect tax side on an ongoing basis through these videos. Be subscribe to our channel and also share this video to relevant people who have such situations on their side and who should be cautioned because this is like almost 1 year has already passed. We are in August and this amendment happened on 26th of October 2023. So better be careful, plan your transactions before going ahead. So please pass on the video to right people. With this, we'll conclude the session. Thank you.
Thank you.
And,
Thank you, everybody.
and let's be in touch.